Well, what in the world is ratio rolling? Welcome, options traders. And I want to talk about what I think is probably one of the more important topics in all of options, especially for all the long-term traders, which, as you know, that's where the real money is. Long-term upward bias in stocks, and we want to stay in these positions for long periods of time, but we want to manage the risk. And one of the best ways to do that is by using a ratio roll. Now, I talked about in the last video about the importance of rolling and why we do it. It was a video called Why Use Vertical Spreads to Roll. And in there I talked about the importance of rolling. Well, ratio rolling is just an extension of that idea. And it's a super powerful way that you can quickly recoup your money but still stay in the position. So let's take a look at ratio rolling and, equally important, how to calculate the net debit for those trades. In the previous video I talked about the basic idea of rolling options. I said, for example, let's say if you have a $100 call option and you want to roll it, you would simply sell that $100 call and simultaneously buy a higher strike, maybe the 105 call. And in doing so, you just set up a trade to sell the 100-105 vertical spread. That's the way it's going to show up in your broker's platform. You're selling the 100-105 vertical spread. But what was most important in that video is that it is always done in a 1-to-1 ratio. And what I mean by that is if you own one call option, you're going to sell one and buy one. If you originally bought 5, you could sell 5 and buy 5. But for every one that you own, you are selling one. You're not doing them in different proportions. However, as every professional trader knows, that in order to take full advantage of these rolls, you must understand the ratio roll. So for example, let's say if the stock is trading for 100 and you purchase 10 of the 70 strike calls for 31. So they've got $30 of intrinsic value, just $1 of extrinsic. These are very deep in the money calls behaving like shares of stock. This would be a stock replacement strategy. But even though it's behaving like shares of stock, it still is a lot of money to put on the table. So what could we do to manage the risk? Well, we might decide to do a ratio roll. So when the time comes to roll these, perhaps we will sell 10 of our 70 calls, but buy maybe only 5 of a different strike, let's say the 90 call. However, your broker's not going to allow you to submit the order this way. You have to put it in terms of spreads. Well, it's a good question. How many spreads is this? Well, in order to answer that, you got to understand your gazintas. What in the world's a gazinta? You know, 2 gazinta 10 5 times, 5 gazinta 24 times. Just kidding. You probably know them from basic math more as the greatest common factor. So let's say that your spread was to sell 10 and buy 5. What's the biggest number that goes into 10 and 5? Well, that would be 5. So 5 is our greatest common factor. So how many times does 5 go into 10? 2. How many times does 5 go into 5? 1. So we would say this is a 2-by-1 spread. For every 2 contracts you're selling, you're buying 1. So what this means is that you are doing this 2-by-1 spread 5 times. So here's why. Let's say you place the order to sell 10 and buy 5. Couldn't I accomplish the same thing by placing an order to sell 2 contracts and buy 1 and wait for that order to get filled? And then place a second order to sell 2 and buy 1? Wait for an execution there. Place a third order to do the same. Wait for that one. A fourth order and a fifth order. That's what I'm doing. I'm placing 5 2-by-1 spreads. And if I got all of those orders executed, I will have ultimately sold 10 and bought 5. So that's what it means when we're placing 5 2-by-1 spreads. All right, so let's say that we want to place this order to sell 10 and buy 5 contracts. Well, as you just found out, we would call that selling 5 2-by-1 spreads, or sometimes you'll see it as 2-by-1 ratio spreads. Called a ratio spread just because they're in different proportions. As with any order, you have 2 basic ways you can submit the order. You can do a market or a limit order. If you submit a market order, it's guaranteed to fill. We can't exactly be assured of the price, but it will be fairly close to the current prices. So if that $70 call is trading for 31, and let's say you're going to roll to the $90 call and it's trading for 14, how much are you expected to get? Well, you're going to receive on your 10 contracts at 31 about $31,000. And for 5 contracts at 14, you're going to receive about $7,000. So the difference there would be $24,000. So your expected credit would be $24,000. But how do we place this order as a limit order? That's where it gets tricky. There's a couple of ways you can figure out the limit order. Both of them are very easy. Let me just show you the first method. Always start with your original order. Sell 10 70 calls, buy 5 90s. 70 calls trading for 31, 90 calls at 14. Just assume that they're going to be filled in their entirety. Selling the 10 calls again, you're going to receive $31,000. Buying 5 of the 90 calls, you'll spend $7,000, and therefore you're going to get a $24,000 credit. However, you're dividing that among 5 spreads. And because each option controls 100 shares, we're dividing it by 500. So you could also submit this as an order to sell 5 2-by-1 spreads for a limit of 48. And of course, that means, as with any limit order, it could only be filled if you get a credit of 48 or better. All right, what's the second method you can use to determine your limit order? Well, go back to your original trade, selling 10 and buying 5. Break it down into the individual components. It's a 2-by-1 spread. So if I'm selling 2 of the 70 calls for 31, and I'm buying 1 of the 90 calls for 14, just use those as your numbers. Selling 2 of the 70 calls is going to bring in $62. That's just twice 31. And then buying 1 of the 90 calls, I will spend 14. What's the difference between 62 and 14? Net credit of 48. So either method is going to show that you could submit this as a limit order somewhere around 48 and probably get it filled. So your final limit order would look like this. We are selling 5 2-by-1 spreads for a net credit of 48. Of course, you're free to change that. Maybe you want to do an or better order and make it 47.5. Or maybe try to get a little more and put 48.10. But if you're trying to attach a limit to it, you have to put a number to it. And in this case, that number is going to be somewhere around 48. Now, some of your platforms will show this as 5 negative 2-by-1 spreads. It's the same idea, just take 5 times your negative 2, that's minus 10. In other words, you're selling 10. 5 times 1 is 5. Those are your long 5 contracts you're buying. So what possible fills could we get here? Here's another area that often throws new traders. If we place an order to sell 5 2-by-1 spreads for a net credit of 48, the order has to be filled in these basic units. That's the whole purpose of breaking the spread down into these component parts, into this ratio. So if I submit a limit order right here at 48, it's possible I could end up selling 2 and buying 1 and receiving $4,800. It's called a partial fill. I didn't get all 5 spreads filled, I got 1 spread filled. Maybe I'll get 2 of those spreads filled and end up selling 4 of my contracts and buying 2 of the one I want to go long, in which case I'll get a credit of $9,600. Maybe I'll get it filled 3 times and sell 6 and buy 3, end up with $14,400. Or I could sell 8 and buy 4. That would give me a $19,200 credit. Or finally, if I get them all filled, I will sell 10 and buy 5, and there you go. There's your $24,000 credit. But the point is, anytime you submit a limit order, remember that it is not guaranteed to fill in its entirety. So where can we break this spread down? We have to break it down into these 2-by-1 components. Those are the smallest units in which this trade can be filled. So just to be clear, you couldn't get a fill of, let's say, sell 2 of your contracts but buying 5. That's not a good fill because it's not in a 2-by-1 ratio. All right, now that you understand the basics of a ratio and how to calculate the numbers here, why do we do it? Well, go back to the original $70 call that we bought. Let's say that we bought this $70 call. Here on this red line, we paid $31 for it. And I'd like to reduce this risk, this area here below 0. Well, if I do a basic roll, let's say from the 70 to the 75 strike, I've only reduced this maximum loss by a little bit. Didn't really accomplish my goal. What else could I do? Well, maybe I could roll up to a much higher strike. Let's say I sell my 70 strike, but buy the 90 strike. Then I've moved from the red to the green. Much better than the first roll, but it still leaves me with quite a bit of losses here. What else can I do? This is where the ratio roll comes into play. What I could do if I sell 10 but buy 5, I've moved my profit and loss curve from this red position to this in green. Notice that I've gotten the entire curve above 0, but I still have the room for unlimited gains. Now, I do have reduced deltas. That's why the slope here on this red curve is steeper than the green. And that's because on the red curve I controlled 1,000 shares, or had 1,000 deltas. On the green curve I am only controlling 500 shares and therefore have 500 deltas. So that slope of 500 deltas is only half that of what it was before. That's my trade-off. Why did I do it? Look what I did to the differences in the losses here. I've moved from a position that could lose a maximum of 31 to a position that can't even lose. And if you use your ratio rolls, a lot of times you can do this on your very first roll. That's what makes it so powerful. All right, here's one for you to try, just a little check. Let's say your order is to sell 12 but buy 8. How many spreads is that? Well, again, figure out the biggest number that goes into both of those, and it would be 4. So if we take 4 into 12, that's going to be 3. 4 into 8 is going to be 2. That's a 3 by 2 spread, but it's done 4 times. So the order would be to sell 4 3 by 2 spreads. What will the price be? Well, that depends on the prices that we're seeing in the open market. Let's say that hypothetically that our $100 calls that we're selling are trading for $10.50. And the 110 calls, the ones we want to buy, are trading for $3.80. So I showed you 2 methods to figure out the net credit. I think the easiest is to just pretend that the entire order is filled. We would end up selling 12 for $10.50, which would give us $12,600. And from that credit, we're going to buy 8 at $3.80. That's going to cost us $3,040. The net credit between those two is $9,560. But we have to divide it out among our 4 spreads. And because each spread controls 100 shares, we have to divide that $9,560 by 400. And that gives us $23.90. That's your limit order. So the final order would look like this. We're placing an order to sell 4 3 by 2 spreads for a net credit of $23.90. What are the possible fills? Remember, the order is for 4 spreads. You can think of it as 4 separate orders wrapped into one ticket. So I might get 4 possible fills. My original order is to sell 4 of these spreads, but they're in a 3 by 2 ratio. So I know it always has to get filled in a 3 by 2 ratio, but it might get done in one of 4 ways. First way, I might end up selling only 3 and buying 2. That would give me a credit of $2,390. That's a good fill. I might end up selling 2 spreads, in which case I would sell 6 contracts and buy 4. That would give me $4,780. It's another good fill. I might sell 3 spreads. There I would sell 9 and buy 6, get a credit of $7,170. And possibly, if I get all 4 of these spreads filled, I would sell 12 and buy 8 and end up with the full credit of $9,560. So ratio spreads are one of the most powerful rolls you can do. So for all the traders out there who are using the stock replacement strategy, and especially for the phenomenal runs we've been seeing on some of the FANG stocks and Amazon and Google, you want to stay in these long term. But the best way to reduce that downside risk is to roll the options at a bare minimum. But when you're using stock replacement, we tend to have higher cost options. Not in terms of extrinsic value, but in terms of intrinsic value. But we still want to guard that. And the best way to guard that is by using ratio rolls. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at OptionsAtoZ.com. Also, please join us on the Facebook trading group Options A to Z. And you can find a link to the site in the description below.